So when I first started this series, I was getting maybe 100 to 150 views on a video, maybe 10 to 15 likes on a video. We are essentially 4 months in to this series where I've managed to maintain consistency with my 1 a week video. We've now reached 2 a week videos, and I'm getting on some videos 1,000 views. I think EasyJet hit 1,000 views recently. Other videos sort of 300, 500, some of them. Likes wise, we're getting something like 70, 80 likes a video, which is amazing. More than I've ever had, and I've had this YouTube video since 2012. And I'll show some graphs which show the amount of views that the channel has been getting since I started doing this show in January, which is awesome. It's so exciting and I'm really enjoying it. I love doing this. I love doing what I'm doing. So it's amazing that there's other people out there that are enjoying the content of the show and, more importantly, gaining some value from it, whether that's entertainment value or some actual educational value. So the best way you can continue to support this channel really is to click that thumb and like the video, subscribe if you haven't done so already, leave comments on the videos. Listen, if you look through the comments on the previous videos, I pretty much get back to as many as I can, if not all of them. So, you know, it's great to hear from people that haven't reached out yet. If you are that person, then now may be the time to drop me a line and just say hi, you know, if anything. Today we're going to take a look at a company called Greggs. Greggs are a very well-known high street retail business, a bakery essentially, and they've been doing surprisingly well. Let's take a look at the numbers. Okay, let's take a look at Greggs PLC then. Epic code is GRG. They're in the FTSE 250 and they are in the food and drug retailer sector. So first thing, revenue's looking really strong. It's continuous growth year on year. We seem to be seeing significant improvement. It's pretty obvious here. We've gone from 630 million a year to the last couple of years breaching the 1 billion mark, which is pretty awesome for them. So congratulations to them for breaching that level. And so that looks really strong. And then when we look at the gross margin, so what's the slice of the pie that Greggs are able to keep, it's been pretty much about 61% every year up until 2016, when we've seen a little bit more of a push. So margin has crept up just a couple of percent over the last 5 years, which is good news for Greggs. It means the slice of their pie that they keep after cost of sales is just that little bit bigger now, which is great. It means revenue's grown, cost of sales has grown, but not quite at the same rate, which is good news. Expenses are quite high, and I think on average we're looking at about 88%. We saw a little bit of a peak in 2013 and 2015 here. The discrepancy on the dates, by the way, is purely down to the accounting period. They get changing the date over from December the previous year to January the next year. It's a mess when you're trying to run out the analysis, but essentially these are the correct figures broken down into years. But yeah, we saw those peaks, arguably 2013 and 2014. And then we've seen in 2019, we've seen a bit of a slump, a bit of a drop in the expenses. So if you take the peaks and you take the troughs, you've essentially got an 88% a year average expenses level. And that's quite high, but it's not to the point where you'd run a mile, you know, and you run away screaming. It's okay. What it will do, though, is it does affect the net earnings, the net profit. You know, if a company is spending 80 to 90% of its gross profit on expenses, there's really not going to be a hell of a lot left in terms of profit. Greggs are doing all right. From, I would say, by the looks of things, 2008 to 2015, which essentially, yes, 2014, sorry. We're looking at about, on average, about 5% a year net earnings over that period of time. And in the last 5 years, we definitely have seen a jump up to, on average, getting closer to 7% a year, getting pretty close to that. And in 2019, we actually breached that to a 7.4% return. So there's definitely in the last 5 years been an improvement. We've seen that in the revenue coming in. We've seen that in the expenses going down. And as a result of that, net earnings has been going up a little bit. So That's positive. It's not at the level that I would like in terms of a company I'd be looking to invest in. I want much bigger net profits than that. And when there are companies out there that produce those kind of level of net profits, why put your money into a company that isn't quite as good? But Greg's looking pretty solid at this early stage of the income statement. Coming down to the balance sheet, current ratio is a little bit low, and it has been historically at that level, so it means that current liabilities are outweighing current assets, and they have done for a while. Let's just take a look at that. Current liabilities, we are looking at 208 million. Current assets 142 million, but they're quite cash heavy in terms of that. Those current assets, which is generally a good thing. The majority of their non-current assets are property, plant and equipment. I want to have a look at their debt levels. 48 million short term and almost nothing to talk about in terms of long-term debt. So here's a company that's in a pretty strong position debt-wise. 48 million is pretty high relative to the net earnings of 87 million, but they pay to pay that off in a year. So it's nothing really. It's well within their levels of what they can cope with, and I would have no concerns there with regards to their debt levels at all. Retained earnings, there's an obvious commitment to raising that pot. So essentially, with the profits that they have, they've got a few things they can do with that. They can pay dividends, which they will, and then they do. They can buy assets in the company to try and improve profits. That might be opening new stores, that might be buying new equipment, whatever it might be. And they can also pump that money into retained earnings so that they can do something with that one day. It might be that an opportunity comes up for them to buy out a competitor, or it might be that they get to expand overseas to somewhere else, whatever it might be. They're currently sitting on 330 million. What I like, though, relative to the actual amount they've got in there, is the consistent commitment to pump in a certain percentage of those profits into this fund. That's a good thing. I like that very much. That's the kind of thing that I look for. The last 5 years, we're looking at a 8% rise in retained earnings every single year. So that's pretty decent. It's not amazing, but it's the consistency more that I'm impressed with. They're also buying back their shares every day. So this is a company that are buying their shares back from customers or shareholders out there that own their shares, buying them back on a share buyback scheme. And what that does is that slowly reduces the amount of shares that are currently out there in circulation. It improves the percentage shareholding of the existing shareholders, and it also helps drive up demand for the existing shares that are left over. When there's less supply and there's more demand, then share prices are going to go up. It doesn't always work that way, but we do tend to see when companies are buying back their shares, it can help drive share prices higher. The return on shareholder equity has been very good for the last 10, 11, 12 years, and in so much that in 2019 we've seen that increase now to 25.1%, which is fantastic. That's a fantastic rate of return on their equity, so very impressed with that. And this is a company that are spending quite a bit of money on purchase of property, plant and equipment. I generally shy away from companies that are heavy in this area, and Greg's are actually pretty heavy in this area, spending 85.4 million a year at the moment on property, plant and equipment. Companies that have to do that to compete are generally companies I tend to stay away from, but that doesn't make them a bad investment. It just means I personal preference, am not as interested, but that doesn't make them a bad investment at all. So numbers wise, Greg's looking pretty solid. Let's take a look at the chart. So this is the chart of Greg's. This is actually on a monthly chart. I've found that in recent times I've discovered that I don't really need to be looking at the daily charts and the ups and downs of every single day's movement. It's really not that important to me what it does on a daily basis, so therefore I find the monthly charts are actually more useful. I can see more of what's been going on, and just having that monthly snapshot is for me a much easier kind of visual for how things have been going, and I tend to use these charts going forward now when I'm looking at this particular strategy. As you can see, from 2008 to 2014 things were relatively flat, sitting about £4 to £5 a share, and really kind of staying within that range up until 2014. And then from 2014 onwards is when we've started to see some real movement in terms of the share price. Now that ties in quite nicely with this column here, which is when the results started to really kind of improve, and we started to see a bit of a jump in revenue. We started to see the increase in profits in terms of the net earnings, and as a result of that, we started to see share prices rise. This also falls in line with the year they started buying back their own shares. So again, these are all the hallmarks of what we're looking for in a growth stock, and you can see it's certainly worked. So over that period of time, if you bought between 2008 and 2014, you would have got in at around £4 or £5 a share. Prior to the events of 2020, shall we say, we were sitting as high as £23 a share. So had you been an investor, had you been looking at those figures over that period of time, seen that they ticked the boxes and got in, you would have done very well as an investor in this company, certainly over the last 5 or 6 years. And that's a very decent level of growth there. Obviously, in recent times, that share price has taken a bit of a hit. For me, that is an opportunity. And I'm not saying this in such that I'm necessarily going to be a buyer, but anybody who is interested in this company and is interested in the numbers still look very solid, right? So bear in mind, and obviously we don't have 2020's financial information. All of these companies have been hit by 2020's events, and Greggs will absolutely have been hit by that as well, being a retail store. The revenue is going to take a significant hit, I would imagine, as will all of the companies pretty much in the FTSE and the FTSE 250 for sure. And so, we have to kind of take 2020's data as an outside source influence rather than the ability of the business. And up until that point, this is a company that was growing. Greggs were growing every single year. Revenue was going up, and they were looking very, very strong, and they were doing all the right things. They were reinvesting back inside their business, and it was everything that I would essentially look for. Apart from, there's just a few things that are keeping me away because I have better options out there for me. So let's take a look at the leaderboard and see how they got on there. Okay, so a couple of things I want to add before we go to the leaderboard in a moment. Greggs are currently priced at £17 a share. At the moment, based on the earnings per share that they produce, they're looking at about 5% earnings return on the share price, the current share price. So if you were to buy the whole company, Greggs, all of the shares that are outstanding, let's say you could buy all of the shares in the company and take it over at £17 per share, you would be getting about a 5% earnings return on how much you paid for the business based on today's share price. What that suggests is that maybe the share price is a little bit high right now. That's just one way of trying to price a company, looking at the underlying value of that business. Another way to do that is to look at the price to book ratio. That's going to give us an insight into how many assets we get in for the price that we're buying. And at the moment, for every pound, you'll be getting about 20p worth of assets, which again is suggesting that the price is just a bit too high. And for me, if I was going to invest in Greggs, I would need the price to drop down to essentially where it dropped down to at the beginning of the 2020 crash. The first month, I think it was March, when the markets crashed down big time. Had we bought at the bottom of that, would have been the best price to kind of get in at. And for many of us, we missed that. I got in on a couple of companies at that price, but not all of them. And so I missed that boat a little bit. And looking at Greggs right now at £17 a share, it may be a good deal for the future. Right now, we're looking at 5% earnings per share return. It's not much. But here's the important thing to think about when it comes to Greggs, is that their 5-year EPS growth is 20% a year. So what that would suggest is that in about 10 years' time, if you were to pay £17 a share for it now, in 10 years' time, you'd be getting, if the company continues to grow at the rate it's been growing over the last 10 years, and that's a massive, big if, but if it did, you'd be looking at a 30% a year return on earnings. And that would suggest that £17 would be a steal. In fact, you'd be willing to pay £30 for it. maybe more than that, £35. And so what that suggests is that £17 a share right now isn't a great deal, but if you've got a long-term hold on this, 10 years, it could actually be a fantastic price to get in at if the company continued to grow at the rate it's been growing over the last 10 years. That's a big if. We don't know if that's going to be the case. And I like to get into companies where I know now that I'm getting a much better return than 5%. And so for me, I'm really on the fence here. I'm really not sure. But if you've got a long-term view on this, you could actually do really well with this company. So let's get them up on the leaderboard. Very solid numbers. I really do like this company. They're doing really well in a sector that they probably shouldn't be doing well in. Obviously, we haven't got 2020's data come through yet, 2020's reports. They're going to get hit, as do most of the stock market, Many people saying that's already been priced and factored into the crash that we've seen. So when the bad numbers come out now, we're expecting bad numbers. So unless the numbers are much worse than is thought, we won't necessarily see another drop in price. If the numbers are better than what everyone has been expecting, then we'll see, maybe even see the price go up quite significantly in a short space of time. So it really is going to be difficult to know where that market's going to go. I'm not one for predicting the stock market. Predictions is not what I do. And so really what I'm looking at is, what is it worth now? What is it probably going to be worth in 10, 20 years time? Does that make it a good investment? For me, Greggs are up there. They're not a bad shout. Definitely, if someone's to turn around to me and say I'm investing a few grand in Greggs today, I would say, yeah, makes sense. I totally get it. There are many other company people email me all the time. They message me on Facebook all the time saying I'm invested in XYZ, and I'm like, why? But Greggs, yeah, I get it. So they've done very well actually, and for once, I did say we were going to start looking at some companies that were doing a bit better. I'm not using the red pen for starters, which is a bonus. Greggs score a very respectable 84 points. Let's get them up on the board. Okay, so a very respectable fourth place, kind of joint with Intertech really. Absolutely up there with some of the best companies we've seen so far on this show. Absolutely deserve that 84 rating, and it'll be very interesting to see how they do over the next 5 to 10 years. Thank you so much for watching, guys. I really appreciate all the support. I appreciate all the views, all the likes, all the comments, all the subscriptions. It's awesome. I'm loving doing this. I hope you're enjoying the show. Thank you so much. Cheers.